Stop chasing entries. That one sentence alone would save most traders years. Because here's the uncomfortable truth. Your entry is not why your trades fail. You can have the cleanest candle, the tightest stop, the most aesthetic setup on your chart, and price will still move straight through you. Why? Because markets don't care about your entry. They care about alignment. And in a minute, you'll see why focusing on entries is the most expensive mistake retail traders make. If you're confused, inconsistent, or frustrated, it's not because you're bad at trading. It's because you were taught the wrong problem. Retail education obsesses over signals. Wait for this candle. Take this pattern. Enter exactly here. But professionals don't ask, where do I enter? They ask something very different. Do enough independent reasons exist for price to move? That difference changes everything. By the end of this video, you'll understand fail, how professionals actually build trades, and how Confluence turns chaos into structure. Not theory, mechanism. 1. The entry myth. Let's kill the biggest lie first. If my setup is valid, price should respect it. Wrong. Price doesn't move because a candle closed nicely. Price moves because large players agree on direction and execution timing. A single signal is not agreement. It's a suggestion. Think of it like this. One witness doesn't win a court case. 5 independent witnesses do. That's Confluence. And without it, your trade is just an opinion. Open loop. So what are professionals stacking that you're not? 2. Markets move top-down, not click by click. Retail traders live on the execution timeframe. Professionals live in context. Higher timeframes define direction, phased decision zones, where liquidity sits. Lower timeframes only decide how to enter, not whether price should move. If you trade a 15-minute long into daily resistance, you're not early, you're wrong. Here's the hidden rule. Lower timeframes execute, higher timeframes decide. This is why multi-timeframe alignment alone boosts win rates dramatically. Not because it's fancy, but because it respects hierarchy. Stop and think. Would you argue with someone who has more capital, more patience, and more information? That's what trading against HTF bias really is. 3. Structure is the market's language. Indicators decorate charts. Structure explains intent. Markets speak in swings. Higher highs, higher lows. Lirararisa lower highs, lower lows. Those are not random. They represent who is in control. And professionals track 2 critical events. B-reek of structure, BOS, continuation confirmed, change of character, CHOCH, control potentially shifting. Here's the trap retail falls into. They spot a pattern without asking whether structure supports continuation or reversal. So price does what structure says, not what the pattern promises. Open loop. But structure alone still isn't enough. 4. Why price hunts stops before moving. Ever notice this? Price takes the high, hits your stop, then runs perfectly. That's not manipulation, that's liquidity engineering. Large players need proposing orders, right clusters of stops, areas of guaranteed execution. Retail provides that liquidity by entering early, placing obvious stops, trading without context. Liquidity sweeps are not tricks. They are fuel collection, and they often precede the real move. Professionals don't panic here. They wait. Because a sweep plus structure shift plus HTF alignment, now probability starts forming. 5. The institutional footprint. Most traders ignore. Price alone hides intent. Volume reveals it. When you see high volume with little movement, absorption. Price making new highs but volume weakening, divergence. Repeated imbalances in one direction, commitment. This is how institutions leave fingerprints without announcing themselves. Retail traders ask, is this bullish or bearish? Professionals ask, is effort being rewarded? When effort increases but result doesn't, something is changing. That's confluence. This approach works not because it's complex, but because it's selective. When you require HTF bias, structural logic, liquidity interaction, execution trigger, risk asymmetry, you automatically trade less, trade later, trade calmer. And that alone removes FOMO. Stats consistently show planned, checklist-based entries outperform impulse trades massively. Waiting filters out low-quality noise. Viewer trades better equity curves. The edge isn't speed, it's patience backed by logic. Let's slow this down. Because this 5-step test isn't a checklist, it's a filter. A filter that keeps bad trades out, even when they look good. And this is where most traders fail. Here's the rule again, and don't skip this. If any one step fails, no trade. Not maybe, not I'll manage it, not it looks clean. No trade. That discipline is the edge. Step 1. Context. Who's in control? First question, always. What is the higher time frame doing? Daily, 4-hour. Not the chart you want to trade, the chart that decides direction. Is the market trending, ranging, or transitioning? Because here's the truth nobody tells you. Most losses don't come from bad entries. They come from trading without bias. When higher time frame direction is unclear, price doesn't trend. It whips, it traps, it chops you emotionally. So the rule is simple. No higher time frame bias, no trade. Not because you can't win, but because probability disappears. You don't need to predict direction. You need to align with it. Step 2. Structure. What's the market story? Now we ask a deeper question. Is the market continuing or changing character? Structure tells you that, and structure doesn't lie. 2 events matter here. Break of structure, BOS. Trend continuation, control intact. Change of character, CHOCH. First sign control may be shifting. Retail traders skip this step completely. They see a candle, a pattern, a moving average cross, and they assume a story. Professionals don't assume, they confirm. Because without structure, there is no narrative. And without a narrative, your trade has no logic behind it. No structure equals no story. No story equals no edge. Step 3. Location. Where is price right now? This is where most good setups die. Same pattern, same trigger, different location. One wins, one fails. Why? Because location controls risk. You ask, are time frames supply or demand? Commemorate, are we inside an imbalance? Near liquidity, buoying cheap or chasing high? A bullish setup at premium is not bullish, it's late. A bearish setup at discount is not bearish, it's impatient. Professionals don't ask, is this a buy or a sell? They ask, is price expensive or cheap relative to context? Bad location equals bad risk. No exceptions. Step 4. Trigger. Permission to enter now, and only now, we talk about entries. This is where retail traders start. Professionals arrive here last. A trigger is not a guess. It's confirmation. On the lower time frame, inside the zone, you want to see structure shift, reject, deposited, imbalance fill, participation. This does one thing. It tells you the market has agreed with your idea. Location without a trigger is just an opinion. A trigger without context is just noise. And here's the discipline part. No trigger, you wait. That's not hesitation. That's professionalism. Step 5. Risk logic. Does the math respect you? Final test. Not technical, mathematical. You ask, is my stop beyond invalidation? Is my target logical, opposing liquidity or structure? Is this at least 2 to 1? Because even a good idea becomes a bad trade if the math is wrong. Professionals don't think in accuracy, they think in expectancy. If I lose small. If I win, it matters. If the math doesn't work, neither will the trade. That's not negativity, that's survival logic. Now let's expose the traps, because knowing the framework doesn't protect you if you keep falling into these. Trap 1. Indicator overload. More tools don't mean more clarity. They mean more opinions, more hesitation, more overrides. Fix. Fewer tools, lure roles. Each tool should answer one question only. Trap 2. Fighting the higher time frame. This is ego trading. Lower time frame signal, higher time frame resistance. You think you're early. You're just wrong. Fix. Bias first, entry second. Always. Trap 3. Entering before liquidity is taken. You see the level, you enter immediately. Price spikes, hits your stop, then runs. That's not bad luck, that's bad timing. Fix. Let stops get taken. Let liquidity form the fuel. Enter after, not before. Trap 4. Emotional micromanagement. Moving stops, taking profit early, watching every tick. That's not management, that's fear. Fix. Define exits before entry. Once in, let structure decide. Trap 5. Overtrading. Trading every move feels productive. It's not. It's expensive. Fix. One high-quality trade is worth more than 5 forced ones. The psychological truth most traders avoid: if you feel rushed, you're early. If you feel bored, you're aligned. Boredom means you waited, you filtered. Fear, go. OMO. Markets punish urgency. They reward patience. Here it is, simple, sharp. Entries don't create probability. Alignment does. Markets don't reward prediction. They reward patience. Fluence isn't more signals, fewer, stronger reasons. So stop asking, where do I enter? And start asking, why should price move at all? That single question is the line between amateur thinking and professional execution. Now be honest with yourself. Which part of your trading is breaking alignment right now? Context, structure, or patience? Don't answer fast. Think.